Hello, everyone. Today on the final bar, my guest is Jonathan Krinsky from Baycrest Partners. We're going to talk about the financial sector, interest rates, the bond markets. This has been, a pretty established downtrend in bond prices, rising rates. What does this mean for the potential next steps for the financial sector, which have had a pretty decent run so far? What is not having a decent run is the S&P today, finishing at the lows of the day, really selling off going into the close, down just under 1%, so not the end of the world, but a nice sort of counterpoint to what we saw on yesterday's session. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, focus on the message of the markets themselves. As I reminded people, as you're struggling with all the headwinds and tailwinds, all the potential catalysts for stock price movements, the one thing to do first, in my opinion, or the most important thing you can do, is focus on price, right? Price tells you what all the other investors are thinking or feeling at a given moment, how they're voting with their capital, how they're voting with their portfolios, and all the other stuff tends to become a lot clearer, a lot more clear in the rearview mirror, right? Down the road, why certain things worked and certain things didn't tend to be a lot more obvious. When books are written about this year, it'll all make sense. But in the heat of the moment, looking at price, looking at how things are moving, I would argue is the best thing you could do to stay on top of things and focus on the trends that are working. We have some great guests coming through the show. I'm super excited this week with some fantastic guests. Jonathan Krinsky joining us later from Baycrest Partners. On Wednesday, we have Jeff Huge from JWH Investments in Minneapolis. On Thursday, Ari Wald from Oppenheimer in New York. Next week, on Tuesday the 9th, we have Jesse Felder from the Felder Report coming back on the show. And also, as a quick schedule reminder, coming up on Monday, March 22nd, we have a special event called Chart Madness. 4 of us will be breaking down a bracket of 16 stocks, debating the pairings, debating the strengths and weaknesses, and come up with our final 4 portfolios, the best of each of the 4 regions. We will then put our portfolios head to head and see how those groups of stocks perform. Should be a lot of fun. You'll hear more about it in the coming weeks, but jot that down on Monday, March 22nd. Let's get to our market recap as we look at the markets today. Again, there's a lot of different things we can think about in terms of sector movements. I'm seeing materials as the only one out of the 11 S&P sectors finishing up on the day. Everything else was down, and it sort of continued to fade lower and lower as we got the last hour of trading, especially the last half hour really sort of accelerated to the downside. And again, not the most brutal market day in history by any means, but certainly indicating some short-term distribution. That's 2 straight days where we've sold off in the last hour. Technology leading the way lower with the XLK down 1 2/3%. The NASDAQ 100 about the same, down 1.7% as well. Overall, the S&P was down 0.8%. Mid caps and small caps down even more. So this is a little more of a risk off day. If you think of yesterday as a risk on day with sort of a bounce off of the 50-day nice recovery, everything's great. Today sort of feels like the opposite. Everything's horrible. Things are all rolling over. And as we've talked about on the long-term trends, these short-term movements, I wouldn't draw too much from one individual day's trading. That can be a lot of noise. I would focus on the long-term trends. And I think that's what's most telling about these days where you have distribution. We're pushing up against some key support levels, some key lines in the sand. I think those levels hold, and you can feel confident that the market's going to hold in there just fine. But those levels start to break, I think we have the risk of seeing a flight to the exits as people start to panic a little bit and deal with a more aggressive pullback or a higher potential of that. Bonds essentially flat today. If you look at the TLT, it was essentially a non-factor day. 10-year yields around 1.42, we'll call it. Commodities mixed with oil prices weaker, although the energy sector down about 0.5%, so not horrible. Gold and silver, sort of precious metals, up. Copper, sort of the base metals, up the most of the group. Natural gas, I should point out, doing just fine as well. As I mentioned, I was on Aaron Swenlin's Decision Point Trading Room on Monday. We ended up talking about natural gas. That was yesterday morning. We ended up talking about natural gas prices and a potential bottom in the UNG. Most other commodities obviously have been in pretty good runs so far. Natural gas in a lot of ways has been a bit of an outlier, but a nice bounce today. Copper as well, which tends to be a good sort of proxy for overall economic growth or economic capabilities. But again, sort of the defensive nature of gold and silver doing pretty well. So let's look at the chart. So if you look at what happened in the last couple days, here's where I would think of it. The 2 weeks prior to last Friday saw a distribution phase coming off all-time highs around 39.50. We have a short-term distribution pattern leading to this trendline support, but also the 50-day moving average. We bounced off of the 50-day. We closed right at it on Friday. Yesterday was a nice bounce higher, but then today giving up over half of those gains from yesterday. So while yesterday felt sort of like a all clear, things are great, a day like today shows you we're not all done yet in terms of the maybe corrective pattern that we've seen here in the last 2 to 3 weeks. So again, I don't think the picture has changed really at all. In general, we've fulfilled the first step of a distribution phase or a bearish phase, which was breaking down that first trend line of support, which we did at the end of January. Phase 2, you break through the 50-day moving average, which we have not done yet, and that's still where I'm looking. Phase 3 would be a break below 3,700. That would be a break below the January low. You will hear me sound a lot less constructive and a lot more risk aware if we start breaking 3,700, because I think that opens the way to higher potential for further downside. Having said that, a break above 39.50, which could certainly happen as early as tomorrow, totally changes the character, shows you that this is another actionable pullback before a ride higher. It doesn't eliminate all the bearish divergences and things we've talked about up until now, but again, you have to follow price. Price is number one on any list of priorities I would do. As a matter of fact, when I teach technical analysis, I start with trend. I start with the overall trend in place and make sure that you measure that first off. What else can we talk about? So as I mentioned, materials, the only one of the 11 S&P sectors higher. Consumer staples, number 2. Healthcare, number 3. Financials, number 4. So overall, it's been one of the better moves in recent months. Has certainly been financials, really starting the clock on November 1st. Financials have been fantastic. A lot of charts at or near new highs in that space and breaking out of bases. What did not work today, sort of the FANG trade, to be honest with you, it's technology, consumer discretionary, it's communication services, it's those three. I was looking at this chart earlier. This is the FanMag chart, as I call it, and it shows you the New York FANG Plus Index at the top, the relative strength of the FANG stocks as a group versus the S&P. And here you can see in the last 2.5 weeks, it's certainly been a distribution, after making a new relative high. Below there, we have the 6 individual components of that index, and a couple of these are at key support levels that are worth paying attention to. Apple is nearing its 200-day moving average, has already broken its 50-day, and is bouncing off of a swing low there. It gave back a little bit of that recent gain over the last week. Today cut about half of that back, but overall, again, has now made a lower high and made a lower low to undercut its January low, and most of these have not done so yet. So out of all of them, that's arguably one of the worst. The other two to pay attention to are Amazon testing this long-term support at the lower end of the range, and also testing its 200-day moving average for the first time in many, many months. The other one would be Facebook. So you have 2 of the 6 FanMag stocks, if you will, testing their 200-day moving average. And again, charts like this holding a long-term moving average overall can be very supportive, because that shows you when stocks pull back, they correct in price and or time, they're able to hold. They're not giving up too much ground. They're holding at support levels where you might expect in a bull market phase, and they're able to recover. Stocks like this fail at their 200-day. And again, I know Facebook and Amazon, all of these names have their own company-specific issues, but broadly speaking, when you see stocks like that unable to hold those sort of support levels, it concerns me about the potential for further downside. And when people see big losses in big names, those are big weights on the indexes. That's when things can get ugly very, very quickly. Having said that, other things to talk about, I think still, if I had one chart to pay attention to, it might be semiconductors. Semiconductors gave up about double maybe actually triple the S&P sell-off, down over 3% today. This is after yesterday's bounce, again, all off the 50-day like other things. I think with the SMH, sort of the levels I would be looking at can it continue to hold the 50-day? A break of the 50-day following with a break of the 225 level, that would be the January low. I think this quickly becomes a very distributive chart that looks very negative. If the 50-day holds, all of a sudden this feels just like the standard kind of stepwise motion like you saw back in September and October. September and October saw pullbacks of a couple weeks each, which felt a lot, pretty bad. Looking back, you can see that those were unusual pullbacks in terms of the amount of price that you gave back up, but overall, all have resulted higher. So that has been the pattern really since the March lows for semiconductors. That pattern breaks, and we have what I would call a change of character, where the chart looks a certain way, and then things change. Either the pace changes, the slope changes, the nature of it changes. And I think a breakdown of the 50-day, breakdown at 225 would validate this bearish divergence that, again, I think is so obvious that we're gonna remember this one for either because it works beautifully or because it totally doesn't work, and you have to remember to be cautious of false bearish divergences in raging bull market phases. But either way, I think this is an important chart to watch, and for what it's worth today, undercutting yesterday's low. So whatever we gained yesterday rallying, we sort of given that back and a little bit more today. We need to take a quick commercial break. We'll be back with Jonathan Krinsky. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we break down the market action using charts together. As a reminder, we'll do another mailbag segment later in today's show. We would love to hear from you and answer one of your questions on the air on Friday's show. Just shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just tag us or just put a comment right below the video that you're watching. We'll gather all those comments and try to answer your question on the air on Friday. Also, as a reminder, the new StockCharts TV on-demand platform is out and released. You can go to stockchartstv.com to set up a free account and start watching videos immediately. We're also on all the app stores. So download the app, check out our content. It's all there, and it's really, really impressive how the team has put together a great representation of our hosts and their great expertise. I want to welcome on my guest, Jonathan Krinsky. Jonathan's the Chief Market Technician at Baycrest Partners, based in New York, relocated to Minneapolis. And Jonathan, welcome back to the show.
Thanks, Dave. Always a pleasure.
So financials have certainly been an area of focus for many of us. And I think, there's been a mix of excitement and panic seeing, the change in bond prices and the increase in interest rates. Start us here. We're looking at the TLT. What are you seeing?
Yep. So bonds have been of big focus of late. There's obviously a lot of implications for what happens with interest rates. And it's kind of interesting that we're coming into the 1-year anniversary of kind of the depths of COVID, and bonds are almost doing the exact opposite of what they're doing a year ago. And a year ago, of course, bond prices were surging, yields were crashing. We saw a bit of a parabolic move higher in the TLT. And we got a reversal, obviously, from that point. This year later, we're seeing the inverse. So TLT got down to what we would consider a historical spread. And, we have about 18 years of price data for TLT. And if you look at it, the spread relative to its own 200-day moving average, it got down to around 13% below that 200-day moving average last week. That's about as extreme as it gets. So our thinking was, that was a capitulatory move in the short term, right? We don't know anything about the medium term from that action, but we know that in the short term, we probably put in a low for bond prices. We can see at least some consolidation, if not a retracement back up in TLT, which would coincide with, of course, yields falling. We think maybe 1.1, 1.2% on the 10-year would be reasonable for a retracement. And then we'll see where we go from there.
It's interesting. I hadn't looked at it in this format, but when you think about how far it is from that, and just the percent below its 200-day moving average is showing you how far away it is from that trend. And obviously, there's been, a huge change in interest rates, right, and bond prices. But it really shows you how exaggerated the sell-off has become, I guess.
Yeah, exactly. It's just funny because it's literally a year ago we were panicking because, well, obviously COVID, but we were panicking a bit because yields were crashing to historic lows, and the last week we were panicking because they were spiking. So it just shows you that, I think, just to wrap up on interest rates, it's almost cliche now that it doesn't matter the absolute level, it matters the rate of change. I think this goes to show you that's exactly what happens because a year ago it was the rate of change to the downside, and it's just completely opposite now.
That's a great take there. Now, also, we've obviously seen an incredible rally in the financial sector, and it's not just a particular part. It's the larger banks, it's regional banks, sort of everything in between. We're looking at Deutsche Bank here. Walk us through what we're seeing.
Yeah, so it's whereas our interest rate call is more of a tactical or short-term trade. I think Deutsche Bank is interesting from a longer-term perspective because even if rates do pull back, I think there's a case to be made that the trend is maybe turning, at least for the medium term, with higher rates. And clearly in the relative strength of financials, that's confirming that. So Deutsche Bank, I think if you were to look within all the major banks, it is clearly the bank that has the worst sentiment. And the chart we're showing here is the price of Deutsche Bank going back the last couple decades, and the percent of sell-side fundamental analysts that have a buy rating on the stock. It's down about as low as it gets, 3%. There's one analyst out of 29 official analysts that have a buy rating on the stock. So it doesn't get much worse than that. And you can see we're flirting with breaking this long-term 14-year downtrend on an absolute basis. And what's really interesting, we don't have time or have the chart with us, but if you were to look at Deutsche Bank relative to the Euro Stock 600 and bring that chart back 15 years, that relative ratio has been under its 200-day moving average literally since 2008. It's just now in the last week or so starting to break above its 200-day relative moving average. So there's a lot of interesting things happening. I think what would be even more bullish is if we do see a pullback in rates and Deutsche Bank actually holds in there, which it's shown it's been doing the last couple of days. And then I think as it moves higher, you could probably expect some of those sell side analysts to start upping the ratings, which usually happens at major inflection points. They tend to chase price a little bit.
So it's a great chart and a great take, Jonathan. We only have about 30 seconds left, and I'd love to know, just thinking big picture. I talked about the S&P earlier, sort of testing the 50-day with 3,700, the low from January. Give us your overall, just quick assessment. Are you seeing more of a corrective pattern? Are you seeing signs of euphoria and rollover, or is it a viable pullback and ride the next leg higher?
Yeah, our view is that we're not at a major peak here for a couple of reasons. One, we saw an absolute massive breadth surge on the last new high. Typically, you do not see price have its final peak with breadth. You tend to see it make a higher high with negative breadth divergence. So that's one reason. Second is just you rarely see massive drawdowns in the same point of the calendar in back-to-back years. So we're literally right at the point where we had a waterfall in equities a year ago. So we think it's unlikely you see that same waterfall this time. So it's a little hairy here. It's a little dicey. You're seeing the growth of value rotation a bit. But overall, we think we see new highs, and then maybe we'll monitor it from there.
It's a fantastic take, Jonathan. Really appreciate you joining the show. Stay safe, be well, best to your family, and we'll talk to you again soon. Same
to you. Thanks, Dave.
That's Jonathan Krinsky. Jonathan is the Chief Market Technician at Baycrest Partners. He's coming to us from the Minneapolis area. And I love that, if you look at the chart of Deutsche Bank that he shared, this is why I miss being at a firm where I got to talk to Jonathan all the time and have people like him come through and show us charts. This is a 15, 20-year chart looking at Deutsche Bank. And it's a reminder, as much as we get caught up in the short-term movements, the short-term fluctuations, equities in general, can be an effective long-term game. And for many of us, if you're a long-term investor, focus on the long-term charts and look at some of these larger rotations. And you're seeing, this rally in financials. When people tell me stocks like Deutsche Bank have had too much of a run and you expect a pullback, I'm looking at this chart that Jonathan shared with us, and I'm thinking this looks like this is like inning one of what could be, plenty of upside if you look at the historical trajectory there. So a great reminder to focus on, at the very least, focus on charts that are in line with the timeframes that you're trying to focus on. It's a great take from Jonathan Krinsky there. Our next segment is the Final Bar Mailbag. So as a reminder, we love to hear from you. Shoot us your questions at any time via email, thefinalbar@stockcharts.com. We'll do our best to get to your questions on the air. Question number one, what exactly do chartists mean when they say new high and new low? Is it the very next swing high or swing low? Is it the next peak or trough that doesn't necessarily have to reach or break the recent high or low? Or is it referring to an all-time high or low? It's a really, really good question. And things like new highs and new lows, that is very much a shorthand. And I will tell you from, working with a team of technical analysts, there are a lot of quick things we would use just to describe charts to one another, because that was sort of the language that we would use to refer to it. So I think there are two different things that you're talking about. For me, when I'm looking at, we'll bring up the chart of the SMH, I tend to use the phrases higher highs and higher lows to reflect that. But when you say something's at a new high, it can actually mean either. A lot of times that means it's to a new high relative to whatever time frame you're looking at. And usually 1 year or the 52-week new high is kind of what you're talking to. But I will usually say a new swing high or swing low, meaning it's broken above the most recent resistance or support level. That's the way I try to differentiate them. And I'll say a new 52-week high, a new swing high as a way to differentiate those. Both of those are sort of a new high. So it's used interchangeably, and it is probably as confusing as your question is implying it is. So sorry, on behalf of all the technicians, I will try to encourage us to use more explicit language and be particular, but that's kind of what I would mean. All-time highs and all-time lows are actually usually different. A lot of times you'll see it abbreviated ATH for all-time high. You'd say ATL, but it doesn't happen that often these days. But ATH would be an all-time high, and that's something that is unique because it represents, it's not just a 52-week new high. It's not something that's like a Deutsche Bank that's had a multi-year downtrend and starts to turn higher. All-time high means it's literally the long-term chart is going up and to the right. And that means something a little different. So it could mean a little of everything. It's probably confusing how we use a lot of those interchangeably. And I would say it could mean a lot of different things. That's why the charts are the best context for you. We got a lot of questions recently on the momentum ETF. I mentioned this last week and it fed some questions. So I'll try to answer a couple of these given the time that we have. Let's see. The MTUM ETF, let's see. Given the look back period and lag in rebalancing, is it appropriate to use MTUM as a momentum proxy when we're in the midst of a major rotation? Wouldn't using MTUM and ratio charts skew our current analysis to reflect trends that have ended as opposed to current trends? And you mentioned earlier in your question how, the momentum ETF MTUM is particularly looking at a 6 to 12 month window. They're kind of soft on what exactly. I think it's weighted probably between those two, and it rebalances twice a year. So twice a year, you look at the best winners over a look back period and you reweight into those stocks. So if you look at the momentum ETF right now, the biggest weightings are stocks like, let's see, Tesla, Microsoft, Apple, Nvidia, Amazon, PayPal, Adobe, Thermo Fisher, Google, and Google or Alphabet. So when you think of charts going up and to the right, I don't know if Apple is the one that would come to mind because Apple is something that kind of looks down like this. But when they did the most recent rebalance, Apple was leading the way, and it was leading the way higher. It was one of the strongest charts. Now they normalize it to, it's not just purely the stocks with the biggest gains. It also adjusts for volatility or some measure of volatility, if I remember right. So it's stocks with the strongest trends relative to their volatility. So it's sort of like the pace relative to what should be expected. So it is not just looking at the stocks with the strongest last X period of time and then just going all into those, because a lot of times that would be a lot of rollover and all sorts of things. So you have to have a window where you're looking. And so, that's why I always caution people, the momentum ETF is a good proxy for the momentum factor. But anytime people show me the momentum ETF that isn't working and they say, well, technical analysis doesn't work, I'm like, well, look at what that fund owns right now. It's not rebalancing in a way that reflects the current trends. And I think to your point on your question, I think you're right. It is really good during established trends. It will be a beautiful proxy of investing in gainers and riding them higher. In inflection points, it will lag behind probably a little bit because it won't rotate necessarily. The timing won't be right. those stocks that had been leading won't lead anymore. But I think your question also implies something that may be a little incorrect when you're saying it reflects trends that have ended as opposed to current trends. Remember, the whole point of momentum investing is looking back at the last 6 to 12 months and buying those stocks. That is the momentum strategy, and that actually works just fine. The problem is the rebalancing, and there's a lag behind when trends will end, and the ETF hasn't updated yet. So using a separate momentum factor, like the scooter rankings are essentially a momentum factor of their own, I would much rather look at the strongest scooter stocks, and I think that's going to be better reflection. The next question, I'm looking at both SPHB and momentum. Essentially, what are the differences between the two, and what's the significance of the ratio? So it's a little mixed thing. I've mentioned last week, momentum, the MTUM, isn't growth, right? Because growth are a certain type of stock versus value, right? So a value stock can have high momentum if the trend has been very good. So don't think that those are interchangeable. Same thing with high beta versus momentum. Momentum is looking at price gains and looking at the strongest performers. The SPHB, the S&P High Beta Index, is actually looking at higher beta stocks. And what that means is when the S&P moves a certain percent, how much does this stock do? If a stock moves more than that, it will have a higher beta, which is basically a higher volatility is another way to think of it. A lower volatility stock, something like a utility or a REIT, will have a beta below 1, meaning when the S&P moves 1%, it will tend to move less than 1%. So when you're looking at higher beta stocks, you're looking at stocks, and I think it's the top 20% of the S&P. I think it's about 100 names in this ETF, and it's the highest 20% if you rank them all by beta, which means in general, you're going to be in riskier names. You're probably going to be in the smaller stocks because they tend to have higher betas, and you're probably going to be a certain sector. So things like telecoms would never be in here. Utilities would most likely not be in here. It's going to be the juicier stuff, sort of the offense. So I think of high beta as a proxy for offense. I think of growth as a proxy for growth companies. And I would look at the MTUM as a proxy for strong trends. All of those could align, and it could be growth companies with strong trends that are higher risk. But those are all independent variables that could describe the same stock or very different stocks, depending on what you look at. That's all the time we have for questions. And again, some of those questions I wanted to spend a little more time answering. Please keep them coming. We have plenty more that we'll get to at the end of this week on Friday's show. We need to wrap the show, though, and go to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is the S&P looking at percent of stocks above their 200-day and their 50-day. I thought Jonathan's comments earlier about breadth were fantastic. And the chart that came to mind as he was talking, I brought it up quickly during our conversation, was the cumulative advanced decline lines, which indeed in February made a new high along with the S&P itself. So some breadth measures I would say are very supportive. Not all of them, though. When I'm looking at the bullish percent index, you're getting a bearish divergence. When you're looking at the stocks above their 50-day, and now arguably the stocks above their 200-day, you're seeing a bearish divergence where the market's going higher, but you're seeing these trend lines or these breadth measures rolling over. So I think it's suggesting to me some internal weakness. I think there's, again, a mixed breadth message. I think you can see some breadth measures more positive, some a little less positive. And I think the question is going to be which of those ends up being correct. Chart number 2 is the what I call the FanMag index. And this is looking at the 6 FanMag stocks: Facebook, Apple, Netflix, Microsoft, Amazon, and Alphabet or Google. And I'm pointing 2 of these out that are testing their 200-day moving averages, Amazon and Facebook. Whether those hold, I think will be really telling when you think about leadership from this sort of space, the mega cap tech, consumer communication services, the FANG trade, but also overall, these are big benchmark names, and stocks like this break down. That means big negative weights on the S&P. That's harder for the S&P itself to go up. So you could find stocks that do just fine, but the indexes are going down because they're dragged down by the mega cap stocks. I think that's an important chart to watch as well. Finally, AXP, American Express. I love ending the show on something that's not going down, something that's going up. If you did not know the market was sort of chopping around, you would not get that feeling from AXP. The last year has been decent. The last 3 months have been fantastic. And if you start the clock at November 1st and look November 1st to now, American Express has been on a fantastic run on a price basis, on a relative basis, and not yet overbought. Recently was last week, but overall, nice, consistent uptrend, far from its 50-day moving average. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Jonathan Krinsky from Baycrest Partners, giving us his long-term take on interest rates. and on Deutsche Bank in particular. As a reminder, the new StockCharts TV on-demand platform is out. StockChartsTV.com, or go to the app stores. You'll find it there as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.